So what takeaways can we, I guess, learn or what can we take away? Probably a better way of saying it, from the latest market decline and then most recent rebound. I think if you look at the market as a whole, and I always talk about the S&P, and if anybody's wondering why, S&P 500, 500 companies, biggest index in North America, a lot bigger than the TSX. Toronto Stock Exchange is just over 200. The Dow Jones, that gets referred to often, 30 stocks. So the S&P is really the main index to look at. And when you look at the fall that we had, S&P went into a bear market, basically down almost 20% from the high. If you look at how quickly the S&P 500 rebounded, it was one of the fastest rebounds from a bear market that we've seen in 40 years. This market rebounded that quickly. And I've said many times on our show here, on my radio show, BNN, everywhere, right across the board, I've said that this decline in the markets was man-made, actually made by one man. And it could easily be rectified and things could turn around if that one person, President Trump, were to make some announcements or do the things that he needs to do to get the economy back moving in the right direction, get trade back, and get the stock market moving in the right direction. So at what point did the pendulum swing from being in the market as being a big risk to not being in the market as being the big risk? Obviously, the quick answer to that would be, well, the bottom of the market, right? When you hit a bottom, we realize that, okay, now the risk of being out of this market is greater than being in the market because markets already come down and reach that bottom. But unfortunately, we never know when that bottom is. And so I have maintained throughout the declines in the S&P 500, declines in the TSX, and all the major indices in North America, I've maintained this whole time that you need to stay in this market. Use this as an opportunity to better your portfolio. Buy good quality investments that are on the cheap. Buy good investment ideas that are paying a very good dividend while you wait for the growth to come. And this is key. And I've been saying this time and time again because I can't tell you how many calls I received from individuals saying, should we be getting out of the market? Should we move to cash? Should we buy bonds, GICs, other investment ideas because things look really bad out there? I can tell you from time to time, things do look bad. We saw it look bad in 2008, 2020, 2022, 2000 with the tech bubble bursting. We've seen this many times before. And what happens? The market moves higher at some point down the road. And not only does it move higher, it makes new highs at some point. Let's take a look at our first chart. And I think this chart sums it up probably best. This is a chart. It's called the investment emotion cycle. And you can see right in the middle of the chart, the point of maximum risk is when everybody is happy. And I'll just go through the chart very quickly. So on the far left, you have, it's still early days. I'll keep my eye on the market. It's starting to move higher, but it's still early days. Then the next point looks like there's real support. I'll invest soon. And then the third point, I've missed some gains, but I'm going to buy. And then at the top, good thing I didn't wait any longer. And that's what I tend to see, right? You tend to see investors getting in at the point where they're like, oh my goodness, this is for real. We need to get in. Well, that is point of maximum risk because in hindsight, when we look back, that would probably be near a topping point. Then right after that, well, market starts to move down a bit, just a small setback. I could always invest more, bring down my average. Then you get to, it can't go any lower from here. I'll sell when I'm above water again. And then finally, the person says, I've had it, I'm out. And I saw investors do that. Come beginning of April, a bunch of investors unfortunately got out at a low. And unless you get back in very quickly, that obviously is the wrong strategy because at the bottom there, you'll see point of maximum fear is also the point where you have possibility for maximum gain. And then you have the saying there is told you so. Good thing I got out when I did at that point, but that is the mistake. That is the point where things turn around and things get better. Our next chart I've shown it before. It is a great chart, a lot going on here. This talks about value of $10,000 invested in the S&P 500 over a 20-year period, 2003 to 2022. So do the quick math, 20 years, 365 days a year. I know the market's not open every day of the year. That's about 7,300 days, 7,300 days. Most of those days, the market is open. If you miss just the 10 best days, your rate of return, if you don't miss those 10, you stay invested, rate of return of 10,000 over 20 years, 64,844. Market goes up, you basically 6 times your original investment, almost 7 times. If you miss just the 10 best days, look how much your rate of return gets cut by more, well, by more than half, 29,708. And then the chart shows miss the best 20 days, miss the best 30 days, 40 days, etc. Until finally, I think if you miss the best, well, let's say 30 days, you're kind of, $10,000 invested would be about 11.7. So you're kind of flatlining. And if you miss any more days than 30 out of 7,300 days, a big number, then your return is actually less than what you started with. The note right in the middle of that chart says in 2020, the second best day happened immediately after the second worst day. And we know this. The best days come after the worst days, the best months after the worst months. Sometimes, and quite often, the best years after the worst. 2008 was a horrible year. 2009, the markets doubled. Investors doubled their money. Many did in 2009. The last part of this chart at the bottom, when were the 10 best days in the market over the last 20 years? You'll notice many of those days are in 2008 during the financial crisis. Many of them are 2020 during COVID. So again, this just continues to highlight, and I want to highlight this. And I know individual investors will forget during the next crisis, but I want to highlight that you can't sell out of fear. Stay the course, especially if you're selling to get back in. It's always easier and easy to sell, but it's very difficult when to get back into this market. And that's the main message I want to get across. I'm not saying we're home and free right now. Obviously, anything could happen. Another tweet, another announcement out of the White House could take this market down. If trade negotiations go sour, yes, this market can go down. But I think we are at a turning point in the trade war. I've maintained that for a bunch of weeks now. And I really believe that as investors, you can't panic, stay the course, buy good quality. And I think over time, as we know, markets do move higher.